Lesson 27. Multi-Timeframe Strategies. Why one chart isn't enough. Let me start with a scene you've probably lived through if you've traded anything. You are staring at a 5-minute chart of some coin, and it is clearly going up. Candle after candle, beautiful green staircase, so you buy in. 20 minutes later you are underwater, because what looked like the start of a rally on the 5-minute chart was actually just a little bounce inside a larger downtrend. The 1-hour chart was telling a completely different story. But you weren't looking at it. That is probably the single most common mistake traders make, and it is the one I want to spend this lesson on. The fix has a name: multi-timeframe analysis, and the idea behind it is small enough to fit on a sticky note. Use a big time frame to know the direction. Use a small time frame to find the entry. Why a single time frame lies to you. Let me be specific about what goes wrong when you only look at one chart. First, your view is too narrow. A 5-minute chart can look strongly bullish while the 1-hour chart is in a clear downtrend. What you saw as the start of a trend was really just a pullback before the next leg down. You bought into the wrong move entirely. Second, small timeframes are noisy. You get golden cross after golden cross, and most of them are false breakouts that reverse within an hour. The smaller the time frame, the more random the wiggle. Third, without context you don't know where you are in a move. You might be buying the very last candle of a trend that has been running for days and is about to roll over. You don't know that, because all you can see is the last 35-minute candles. Multi-timeframe addresses all three. A higher timeframe tells you what is actually happening. A lower timeframe tells you when to act. That is it. The whole technique is built around that one distinction. The 3-layer decision model when you are comfortable with it. Most multi-timeframe strategies break down into 3 layers, and I'd encourage you to think of it this way rather than as a pile of indicators. The first layer is the major timeframe, and its only job is to tell you the direction of the bigger trend. On this layer you ask one question: are we in an uptrend, a downtrend, or no trend at all? You typically use slower indicators here. Things like the 50 and 200 EMAs, the ADX for trend strength, maybe the MACD. The decision this layer makes is binary and boring. Am I allowed to look for longs? Am I allowed to look for shorts? Or should I sit on my hands? The middle layer is the confirmation timeframe. It is there to tell you whether the trend is still healthy and whether an opportunity is forming. You might look at the 20 or 50 EMA, the RSI, stochastic, that sort of thing. It narrows things down. It tells you whether the bigger trend is actually continuing and whether a setup is starting to brew. The third layer is the entry timeframe. This is where you actually pull the trigger. You want faster indicators, like the 9 and 21 EMAs, shorter RIC readings, candlestick patterns. The question here is precise. Right now, this minute, is it a good moment to enter? 3 layers, 3 jobs: direction, confirmation, entry. When you frame it like that, every multi-timeframe strategy is just a variation on that skeleton. How to pick the timeframes? People always ask which timeframes to use. And there is a real rule of thumb here, not just vibes. You want each layer to be meaningfully bigger than the one below it. A common ratio is somewhere between 4:1 and 8:1 from one layer to the next. So if your entry timeframe is 5 minutes, your confirmation layer should be somewhere around 15 or 30 minutes. And your trend layer should be an hour or higher. The classic combo for short-term crypto trading is 1 hour for trend, 15 minutes for confirmation, 5 minutes for entry. That is a 12:3:1 ratio, and it works well. For swing trading, you'd stretch it out, something like daily, 4 hour, 1 hour. For more scalping style trading, you might go 15 minutes, 5 minutes, 1 minute. The pattern is the same, only the scale changes. 2 mistakes I see a lot. The first is picking timeframes that are too close together, like 5-minute, 3-minute, 1 minute. They're all telling you basically the same thing, so you don't get the cross-check you think you are getting. The second is using too many timeframes. Once you go past 3 layers, you are just creating complexity for its own sake, and you'll spend your time reconciling conflicting signals instead of trading. 3 is plenty. How Freak Trade does it. The informative decorator, now the practical part. In Freak Trade, multi-timeframe is handled by a feature that I genuinely think is one of the most elegant things in the framework. It is a Python decorator called informative. Here is how it works. You write your strategy's main time frame, say 5 minutes, the way you normally would. Then for any other time frame you want to use, you write a separate method, decorate it with the time frame you want, and inside that method you calculate indicators on the 1-hour data just like normal. Freaktrade handles the merging. It computes the 1-hour indicators, then it lines them up with your 5-minute candles and appends them to your main data frame with a suffix. The naming is the part to remember. If inside your 1-hour method you calculate a column called EMA50, when it lands in your main data frame it will be called EMA50_1H. Same for RSI_1H, ADX_1H, and so on. The suffix is just the time frame label. That means in your entry logic you can refer to higher time frame indicators as easily as the local ones, just by using the suffixed name. So in plain terms, a typical entry signal combines conditions from multiple time frames in one line. You might say, enter long if the 1-hour trend is up, meaning the 1-hour EMA50 is above the EMA200, and the 1-hour ADX shows a real trend, and on the 5-minute chart the fast EMA just crossed above the slow one. The bot evaluates all of those together every candle, and only fires when they agree. You can stack multiple informative decorators on different methods to add as many time frames as you want. A common setup has one method for the 1-hour, one for 15-minute, and the regular indicator method for the 5-minute. The labels just keep stacking, 1H15M, and nothing for the main time frame. A trend-following example let me describe a complete strategy so the pieces fit together. The logic I'll describe is a classic trend, following multi-timeframe setup. On the 1-hour chart, you confirm a bullish trend. You want the 50 EMA above the 200 EMA, the price above the 50 EMA, the ADX above 25 to confirm there is real trend strength, and the MACD above its signal line. That is your trend gate. If any of those fail, the bot won't trade long at all. On the 15-minute chart, you wait for a pullback. The trend is up, but you don't want to buy the top. So you watch for price to dip back near the 20 EMA, with the RIC cooling off somewhere between 40 and 60, not too weak and not too strong. That is your setup. On the 5-minute chart, you wait for a golden cross. The fast EMA crosses above the slow EMA, RSI is above 45, and volume is above its 20-period average. That is your trigger. When all three layers line up, the bot enters long. The exit is usually the inverse of the same logic. The 1-hour trend starts to roll over, the MACD flips, or you get a death cross on the 5-minute, and you are out. Notice the discipline this enforces. You are not buying every golden cross on the 5-minute chart. You are only buying golden crosses that happen during a confirmed uptrend, after a clean pullback. That filter is what raises the win rate. A mean reversion variant, the same skeleton works for the opposite style. Mean reversion. The setup is different, but the layering is the same. On the 1-hour, you want the opposite of a trend. ADX below 25 tells you the market is ranging, no clear direction. That is your green light for a mean reversion approach. Because mean reversion fails badly in strong trends, on the 15-minute you look for extremes. RI below 30, or price tagging the lower Bollinger Band. Something stretched. On the 5-minute, you wait for the first sign of a turn. Reticking back up, price reclaiming the 20 EMA, volume picking up. Then you enter, expecting a snapback toward the middle. The exit is when the snapback completes. The 15-minute RE crosses back above 50, or price hits the middle Bollinger Band. You take your profit and wait for the next stretched setup. Samey 3 layers, completely different trading style. That is the strength of this approach. You pick the style first, and the layers fall into place underneath it. Going a little further once you are comfortable with the basics, there are 2 variations worth knowing about. The first is dynamic timeframe weighting based on volatility. The idea is that in choppy, high volatility markets you trust the higher timeframe more strictly, because noise will eat you alive. In quieter markets, you can loosen the rules a bit. You compute something like ATR as a percentage of price, and you branch your logic. When volatility is high, you demand a higher ADX, a stricter trend confirmation. When it is low, you accept a simpler signal. It is a way of letting the strategy breathe differently in different regimes. The second is replacing hard yes or no conditions with a weighted scoring system. Instead of saying all 5 conditions must be true, you assign points to each. The 1 hour trend being up might be worth 20 points. The ADX being above 25 is another 20. The 15-minute RI in a healthy range is 15, and so on. You sum the score, and you only enter when it crosses some threshold, say 70 out of 100. The reason people do this is that hard conditions are brittle. One indicator flickering can kill a perfectly good trade. A scoring system is more forgiving, and it lets you express the idea that some signals matter more than others. The 1 hour trend really is more important than the 5-minute volume, and the weights should reflect that. I'd warn you though, scoring systems are also a slippery slope toward overfitting. You can tune those weights forever to make the backtest sing. Keep the weights round and sensible, and don't optimize them to death. Pitfalls you will hit. Let me save you some pain with 3 problems that catch almost everyone the first time they try this. The first is all your higher time frame indicators showing up as NaN, meaning empty. The cause is almost always that your startup candle count is too small. Here is the math. If your main time frame is 5 minutes and you want a 1 hour EMA 200, you need 200 1-hour candles of history. Each 1-hour candle is 12 5-minute candles. So you need at least 2,400 5-minute candles in your startup buffer just to get that indicator warm. If you set the startup count too low, the indicator never has enough data, and it just returns NaN, and your signals never fire. Bump it up. 2,000 or 3,000 is not unreasonable for a strategy that uses the 1 hour EMA 200. The second is signals not triggering at all. When that happens, the fix is to print the conditions. Break your entry logic into separate Boolean variables, count how many rows satisfy each one, and you'll see immediately which one is the bottleneck. Usually it is one condition that is almost never true, often because the threshold is too strict or the indicator isn't being computed the way you think. The third is backtests that take forever. Multi-timeframe means more data, more indicators, more computation. The practical fixes are to only add indicators you actually use on each timeframe, to keep the startup count as low as the indicators will tolerate, and to start with a short backtest period for sanity checking before you run the full multi-year test. When you backtest, you'll typically see a multi-timeframe strategy beat a single timeframe version of the same idea on most metrics. Higher win rate, fewer trades, smaller drawdowns, better Sharpe. That is the whole appeal. The trade-off is that you take fewer trades, because the filters are stricter. In my experience, that is almost always a good trade. I'd rather take 60 high-quality trades a year than 200 mediocre ones. The honest take I want to end with the part that matters most. Adding timeframes is not automatically better. I've seen plenty of strategies where a clean 2 timeframe setup beats a fussy 4 timeframe one. Because every extra layer is another way to disagree with yourself and another thing to overfit. The point of multi-timeframe isn't complexity, it is clarity. You want the major time frame to tell you whether you should be trading at all, and the minor time frame to tell you when. That is the whole job. If you keep that frame in your head, you'll write better strategies than someone who just stacks indicators because they can. One more thing. The backtest numbers on a well-tuned multi-time frame strategy can look genuinely good. But remember what we talked about way back in Lesson 1. A backtest is a description of the past, not a promise about the future. A multi-timeframe strategy that has been tuned to perfection on 3 months of data is just overfitting with extra steps. Test it on data it hasn't seen. Paper trade it live. Give it time to prove itself before you trust it with anything that matters. And start with 2 time frames before you reach for 3. Walk before you run. That is multi-timeframe in freak trade. In the next lesson we'll move on to a different family of strategies and keep building.